David. Hello, David. Hello, Ron. Thank you very much for popping hello in the chat box. A very interesting name, Beatley Kung Fu. Hello, welcome. Hello, Ian. Hello, Paresh. Perry. Hello, Robert. Vito. Everyone's logging in for the moment, and we're live on the YouTubes too. Perfect. Okay, so let's get rocking and a rolling. So if you've got questions, comments, as always, pop a little notice in the chat box. If you've got a stock that you want me to look at, pop it in the chat box below. I've got you on the Zoom. I've got you on the YouTubes on the other monitor. So when it's there, I'll see it. And good morning, Randy. Hello, hello, hello. All right, so the general theme that I'd like to run through in today's session is quality control. Are you doing everything that you're supposed to be doing? And that could be from trade's point of view, or it could be from a strategy point of view. I'm going to look at 3 or 4 elements, but essentially when you have a rule-based process, you can essentially have a checklist system, and we get to quality control ourselves. Again, I refer to what I do as a production line, so it just sticks with the narrative of the way that I like to trade for myself. But the bottom line is if you're not doing everything you're supposed to be doing, then you're not following the process. So we get to check ourselves for quality control, quality assurance, and these are, and there are, to be fair, there are several questions that we'll look at in just a moment to help guide our thinking process around this. Before we get there, though, if you're looking to profit from daily, weekly, or monthly swings in the markets, then you're in exactly the right place. So welcome one, welcome all. My whole philosophy around trading, even more so the longer I'm doing this, is that trading should be simple and it should work, not just for me, but also for you. If you're trying to emulate what I'm doing, it should be replicatable. You should be able to see comparable results. I'm never going to say that you'll get exactly the same. I don't know your situation. There's obviously going to be times where we simply just miss a trade. If you're not at the desk, you physically can't place the same trade. So as long as you can emulate something that is comparable, then we're all pointing in the same direction. And that's really what it should be able to do. I'm going to outline my money-making patterns. We're going to wrap it around the veil of quality control, as I've already mentioned. But my whole purpose with these open sessions is to give you the right tools, the rules, the software to assist you, be a community to support you, and if you'll allow me to be a mentor to show you the way, certainly the way that I trade, so that you can get real results in the smartest possible way. One of the reasons why I do this is there's so much bullshit out there. It's sometimes hard to sift through it. And ultimately, I never had anyone to ask when I first started out. Simple little things like, how do we do the things that we do? And unfortunately, because of all the confusion and misinformation, a lot of the basic tenets of trading just gets lost. For example, the easy example is BTFD. Everyone touts this phrase around, buy the dip. But for most people, it doesn't necessarily mean what we think it means. We need to go a layer deep. And this is part of the process that I teach all my traders. It's the part of the philosophy that I use. And that's to put more meat on the bones. Again, keep putting more definition on what you're doing. We need to just simply add buy the dip in the context of an uptrend. If there's no uptrend, there is no dip to buy. It seems bloody obvious when you say this. But the reality is that this is what most people do. Most people buy any down day and call it a dip. And the reality is we need a trend to be able to buy a dip. It's silly, stupid, simple, but unfortunately, this is a huge mistake that most people make. Other traps that people fall into are what I lovingly refer to as zombie trading. Quite literally flicking through chart after chart like mindless zombies, hoping that the next one is the one. And all you end up doing is the stock market equivalent of where's Wally? Is this it? Is this it? Is this it? Other traps that we can fall into are triple time frame bullshit, essentially. Going from the monthly, the weekly, daily, or the weekly, daily 60 minutes, or the daily 65 minutes. Whatever bullshit you convince yourself of, this triple time frame analysis, all it does is create conflict. You're going to have one or two of the time frames out of kilter with the third. And again, all it does is create confusion. And by the time they are in alignment, you've missed the move. So what's the fucking point in the first place of doing this ridiculous hop, skip, and a jump? We see here every week that you only need one time frame. One time frame, one tool, one indicator. Let's go all Freddie Mercury and gimme fried chicken. It's simplicity at its best. Other things that people do are just keep stacking indicators, trend lines, some sort of automation. 1, 2, 3, 4, 5, 10 indicators. We've all done it. I've done it, but the reality is, again, you've got that same conflict. You need the right tool for the right job. You're not going to use a screwdriver to hammer a nail, and you're not going to use a hammer to screw a screw. Same in trading. We need to know what our objective is and then find the right tool to assist us in that, because otherwise it's just going to create conflicts, confusion, stress, second guessing, sleepless nights, anxiety, and all the other myriads of emotions that come along with not knowing what you're doing and hoping that it works. You might as well just buy a lottery ticket if this is what you're going to do. And ultimately, if you're ever asking yourself the simple question, where's the trade, then you're doing it wrong. You should never, ever be saying, where's the trade? We can certainly ask a series of questions that will lead us to a conclusion, but we want to end up with a statement, there is the trade. Oh, there it is right there. And that's what I want. I want it in my own trading. It gives me certainty. It gives me peace of mind. And it gives me consistent results. It's an on-average return that I'm looking for, which is what I want for my own training, and it's what I get for my students as well. Just like Kyle, Stephen, again, the half a dozen people that we've got on here, again, I've had thousands of people through my training programs over the years, and they all get comparable results following one of the family of strategies that I currently have. Again, primarily, I like to swing trade stocks. We can short-term swing trade. We can also look for the main move of the day on S&P futures. We can also capture the morning swing if you should fancy day trading. Again, in the interest of disclosure, I don't like doing this. I spent 12 years day trading, but nonetheless, the process and the principles that I use can be used with a few tweaks and a few adjustments to trade the trend, wherever that may be on any time frame that you may fancy trading. I've lost my place in the slides. Bear with me, folks. One last final announcement. I do have a brand new podcast. If you've not listened to it just yet, just simply search AntiVestor in your favorite podcast player, and you'll see a picture that looks like this, and you can listen to the latest episode. I think we're 15 episodes in. Again, I do have another podcast with a partner in the US. Again, I have been running it for several years. So this is my own solo show. If you'd like to download and share that with someone who needs to hear the message that we have here each week, then please feel free to do it. Now, before we dip into the charts and get into it, I do have to say a few things. I am not a Wall Street guru. You should most definitely not listen to me. Nothing I say should be considered as financial advice. Past performance is no guarantee of future performance. It's your money. Don't be a dickhead. Don't blame others for your inadequacies. What I can do, though, is I can show you that the charts and history does repeat itself. It does sing from the same song sheet. It'll never be exactly the same, but it does sing from the same song sheet, and that's what I will show you. I'm also just a regular guy. I found my own measure of success. Again, I'm nothing special. I'm just further along the journey than maybe one or two of you are. And again, I figured a few things out along the way, and that's what I'm aiming to show you here in these open sessions. As always, I like to practice what I preach. I do get results for myself, and obviously my students are able to get some measure of performance. Here's some of the recent trades. Unsurprisingly, the majority of them are on the bearish side. Monday, I did close Baidu. We've been tracking this for the last couple of weeks. Or to be fair, most this year, actually, but the last several weeks. This is the short-term version. It's actually just fired off a brand new entry. I'm sure we'll take a look at later if we have a moment. But ultimately, if you need some assistance with your own trading, just understand that there is a place for you. If you'd like to work more closely with me, you can do. Again, this is as hard a pitch as you'll ever get from me. I'm a trader first and an educator second. There is by no means any obligation for you to work with me. It is an application because I don't work with everyone. Now, with that said, let's jump back to the fancy dancy slide of quality control. Let's get into it. Are you doing everything that you're supposed to be doing? There are a few questions that I asked myself, as I mentioned earlier, around this. And what we want to be doing is we want to be asking, what stocks are we looking at? What stocks have we managed? Are we doing everything that we said we were going to do? Basically, did we follow the strategy? Are you in all your potential? This is what we're going to focus on, the quality control aspect, the last couple of questions there. I also like to have a little research project. Again, usually it's some form of strategy development or trying to improve the algorithms that I develop. And again, if there's any lessons to be learned, then obviously we go through these. These are just some of the questions that I use to guide myself. Again, we're going to focus this one on, or specifically on this question. Are we in all our potential? So with that said, let's hit the charts and answer that very question. Excuse me. Right. So let's think about quality control. First off, let's look at the strategy. Let's look at the strategy. We also need to know what we're doing to be able to evaluate if we're doing it right. Let me skip past. Let me go through the bullish example. It's always a little bit easier to explain. Everyone's usually got the concept. And if you weren't already aware, you did know that we can profit from upward movements in the markets as well as, downward movements as well as upward movements in the market. It's called selling short. We can buy the dips. We can conversely sell the rallies. I'll go through the bullish example first, and then we'll look at the bearish example because we are in a bearish phase of the market at the moment. But nonetheless, both the same. And ultimately, you know, two of my money-making patterns: buy the dip, sell the rally. Cool. So the first thing I'm going to do is I'm going to look for the average price to cross over. I'm looking at the 200 period moving average over here, the 50 period moving average. I've also got the 20 period moving average. And as I always say, there's nothing special about these indicators. It allows me a mechanical frame of reference. That's the only reason why I'm using it, mechanical frame of reference. If you're doing anything that requires subjectivity, for example, trend lines are subjective. Everyone can place them at a slightly different location. It means that they're not replicatable. Similarly, if you're using Dow 3, GAN 3, Elliott Wave 3, any of the other stuff that requires some form of interpretation, pattern analysis, geometric shapes, fractals, all of that stuff. Again, I spent 12 years doing it. I'm very good at it, but it's not replicatable. So this is why I'm using these tools. We can all agree where price is in relation to the 200, the 50, or the 20 period moving average. It is a statement of fact. Where is price in relation to 1, 2, or 3 of the moving averages? So the first thing I'm looking for is for the 50 to be above the 200. At that point, I will say I am bullish. Obviously, the opposite is true. So the 50 is above the 200, as we can see here. We can call that the crossover. That's not the automatic indication to go long or be a buyer. I'm just going to be biasing myself to one side of the market at this point. At that point, I'm looking to see price push away. You're always going to miss the first part of the movement. So you want to see price push away and come back into the 20 or so, the 20 or the 50. I'm just going to focus on the 50 and the 200 for the moment, but come back into the 50. Again, just talking about one of them, the moving averages for simplicity. But nonetheless, we've got the bullish direction, price pushing away, and then price to come back into the 50. There's plenty of down days up to the point of where it then touches the 50 period moving average. That's what I'm interested in. I can ignore all of that down move until it touches the 50 period moving average. That's when I'm interested. At that point, that is what I'll call a dip in the context of a trend. Is everyone happy with that first point? We've got the trend bullish. We've got price coming back into the 50. All the down days can be ignored until it is at the 50 period moving average. At that point, I will say this is the dip that I'm looking for. These are the dips that you're looking for. Does that make sense? Everyone happy with that? Very simple interpretation. It's also mechanical. Everyone can agree. Everyone can agree with that interpretation. Makes it repeatable, it makes it replicatable, it also makes it mathematically quantifiable, and all the things that end in able. And what I can then do when I've finished explaining this is I can codify it. I can hire a programmer, yeah, which is what I've done. And I can put all of those rules that I'm explaining to you right now into a mathematical formula. Absolutely, Brett. Fantasticable. Awesome, David. Thank you very much. And again, it's super simple. Don't underestimate the power of this simplicity. It's very easy to disregard their simple. I've made trading complex over the years. I've used algorithms. I've used all the fancy stuff that I mentioned earlier. But simple beats complex most of the time. It doesn't always, but most of the time. So what we're trying to do is trying to profit from the push away. That's the bit that we want to profit from. Find the dip. There's the 50-period moving average. So that's my dip. And we want to profit from the push away from the moving average. Find the dip, which is there, and we want to profit from the push away. Find the 50-period moving average dip. We want to profit from the push away. They're not always huge, as you can see here. Slightly break even, but back to the 50, there's the dip. We want to profit from the push away. Again, I'm stating the obvious because it should be bloody obvious. When you've got a quantifiable, definable rule that says when price is at the 50-period moving average, that is the dip. And when it pushes away, that makes it a dip worth buying. I'm sure we all get the point. That is, in essence, all I'm doing. There's a few other things. I actually have 6 money-making patterns, but this is my number 1 money-making pattern. Number 2 is the inverse, sell the rally in a downtrend. What this means is if I then sprinkle in my preferred money management method, at the click of a button, I can say, well, if I just did that, I did nothing else, I can have the computer look back over the last 20 years. I can have it look back over as much data as I've got, but 20 years is plenty. We've got bull markets, bear markets. We've got a couple of crashes. We've got several flash crashes. We've got quantitative easing. We've got quantitative uneasing, as we're looking at right now. But we've got a lot of different market conditions is the point. So if I just did that over 20 years, I did nothing else. I didn't think about Fed, didn't think about Elon tweeting, Trump tweeting, other people tweeting. I didn't think about the economic reports, subjectivity, nothing. I just bought the dip, sold the rally when the data said to buy the dip and sell the rally. What this is a visual representation of a positive equity curve. It makes money is the bottom line. That's all I'm doing. And that is what I'm here to show today. So buy the dip, sell the rally. Again, sprinkle a little bit of money management. I appreciate for these open sessions, there's a little bit more to it, but the crux of it is that's the entry vehicle. Conversely, as we said just a moment ago, I can also sell the rally. So that's what we're looking at right now, sell the rally. So the opposite is the 50 is below the 200. That gives me a bearish bias. So any downward movement is the bit that I want to profit from. So when price pushes away from all 3 moving averages, that's the bit that we want to profit from. When it comes back to either the 20 or the 50, then this is our rally worth selling. So when it goes below all 3, that's the bit that we want to profit from. Back to, and then when it goes below all 3 moving averages, that's the bit that we want to profit from. Same process. Right now, we've just come back up to the 50. It's starting to push away from the 50-period moving average. Again, that is my rally worth selling. Bearish, sell the rally, bullish, buy the dip. And in both cases, we've quantified what each of those things mean to me. I know what the trend is. I know what the rally in a downtrend is because of that. And I know what the dip in an uptrend is because, or if there is a bullish trend. Now, that is what I'm doing. That is what I'm doing. So the next part to this, let me just put this. So the chart area is intentionally blank. So the next part to this is I want to apply this process on my top 25 stocks. What this allows me to do, so again, the chart is intentionally blank. I'm going to apply this process to my top 25 stocks. These stocks over here on the watch list, these are stocks that using that process that I've just mentioned means that, oh, sorry, if I plugging the liquid stocks, I'm trying to paraphrase. How did I come up with these stocks? Sorry, that's what was kind of in a little bit of a mental loop over. Just bear with me a second. But these top 25 stocks, what I've done is I've taken the most liquid stocks that have high volume. And I've explained this in detail in the past. High volume, they've got stock options because I'm going to trade with stock options. That's how I prefer to trade. I'm going to make sure that those options have liquidity. The idea being is when you've got highly liquid stocks and liquid stock options, you're left with about 2,000 stocks in the known universe before you do anything else. So you can filter all the possible stocks in the US markets and just say, if it's got over 1 million shares and it's got over 1,000 options traded in a month, and it's that'll bring the universe of stocks down to about 2,000. What I can then do, and this is the only time-consuming part of what I do, is I can then run the algo that I've just explained through those 2,000 stocks, or more specifically, run those 2,000 stocks through the algo. And then that brings it down to about 300. So I have a master universe of stocks of around 300 stocks. And all I've done is I've taken the top 25 stocks from those 300, and that's what they are over there. Does that make sense? Everyone happy with them? Again, I'm okay with the big dollar stocks. Again, your top 25, again, my students' top 25 may be different from mine, which is fine, because maybe you want to trade stocks that are less than $50, or maybe you want to trade $20 to $30 stocks. So what you do is take that master list of stocks and find the stocks that meet the $20 to $30 range because they're in your wheelhouse. So I'm just trying to explain how I've created my top 25. I just took the best, the cream off the top, essentially, the best of the best of the best. So that's what we have here. I'm going to take my top 25 stocks. So because I've got this algo, again, algo, step number one, have an algo. And all this is a strategy with rules. If this thing happens, then take this action. That's all an algo is. It's just a fancy way of saying if this, then that. The second part to trading any strategy is consistency. Just like a business, we want to open up the shop from 9 to 5, Monday to Friday. We want to have the tills staffed, the shelves stocked. Coughing a lung up. The shelves stocked. We take that for granted. So all we're going to do is we've got the strategy that works, the business concept, and we want to trade the top 25 stocks. This is the shelves are stacked. That's all we've done here. And we want to get consistent and open the shop 9 to 5. Everything's ready for our business. So that's what we're doing here, the business equivalent of opening 9 to 5 and making sure we've got stuff to sell potential customers. Because I don't know which trade is going to work. I don't know if this one's going to work, the next one. I don't know if I'm going to have a month of trades that are just shite. I don't, insert your own expletive. I don't know. No one knows what is going to happen tomorrow. What I do know, which I've just demonstrated to you, is if I apply the strategy consistently over multiple occurrences, then I should have an on average expectation of making money over the next 6, 8, 12 months. So I need to take these top 25 stocks and trade them consistently. So I'm not trading anything else. I'm not trading meme stocks. I'm not bouncing around from chart to chart, from time frame to time frame, from indicator to indicator. I've got a strategy that works. I'm going to apply it to a group of instruments that are proven to work so that I can get consistent results, so that I've got that on average expectation of making money. That's what I'm looking for. So what I can then do is, because I've got a simple strategy that is proven to work, I can codify what I'm looking for. So these red blue boxes here, these are just codifying what I've just described to you. The column here that says trend, bull bear trend, this is the which direction are we going? So I can quite easily separate the stocks that are bullish and the stocks are bearish. So this group of stocks here, these are all in a what's known as a bullish crossover. That's where the 50-period moving average is above the 200. And this group of stocks here are bearish. And that means that the 50 is below the 200. That's what we've just got looked at. So I can see that there's a number of stocks that are bullish and a number of stocks that are bearish. Next thing I can do is I can sort the stocks that are above the 200-period moving average, because we want price to be above the 200 for a bullish trade and below the 200 for a bearish trade. So again, what you're watching me do is I'm just separating these things off. So we've got these three down here. These three down here, they're in a bearish crossover, so I'm biased bearish, but we can see that price is above all three moving averages. So we've got conflict. So I can essentially ignore those three stocks temporarily because they're out of sync with the direction. The average prices are bearish and crossed down. I'd be looking to sell rallies, but price has rallied too much. It's above all three moving averages. Let's just put them to one side and not worry about them for the moment. So that's how we're going to deal with that. And similarly, we've got the same thing. We've got a bullish crossover here. To do just as I'm highlighting, bullish crossover, but prices below all three moving averages. So I'm just going to ignore that. So next I'm going to do, I'm just going to double click on the 50-period moving average and sort where's price in relation to the 50-period moving average. So it's, for example, this one is in a bearish downtrend. It's below the 20, but above, my apologies, below the 200, above the 50, above the 20. So that's a slightly deeper rally in a downtrend. It's a rally in a downtrend. So visually I can see, hey, that's a rally in a downtrend. I might need to take some action on that soon. Don't need to worry about it today, but I can just sort and sift all the stocks that are rallying in a downtrend. So I've just done the same thing with this column here, and I can just put those together. So these stocks here, these are all the stocks that have a rally in a downtrend. And conversely, I can see that SQM here is a dip in an uptrend, which is great. Now, what I get to do is what I mentioned earlier is I get to quality control. I can quality control. So this group of stocks here and the top three there, they're all blue, blue, blue. They're all the blues. Blues checked, you know, got 1, 2, 3 blues. Price is above the, is bullish. So above the 20, above the 50, above the 200. That should be the bits where price is pushing away from the moving averages. So I can quality control myself. So rather than focus on the entries this time, because we've spoken about that many times in the past. And conversely, I've got all the reds here. So price is below the 20. It's below the 50. It's below the 200. And the average price is crossed down. So you're looking for bearish trades. So that's where price is pushing away down below the moving averages. So what I get to do again is quality control. Am I in those trades? Because if I'm not, then what did I do wrong, if anything? Does that make sense? So these top three here, COP, I should be bullish on those. So I get to quality control. Well, if they're pushing away from the moving averages, it's a rally in an uptrend. I should be participating in those three bullish trades, COP, CVX, LNG. They're the bullish trades that should be making me money. Am I in any of those trades? Yes, I'm in COP. Yes, I'm in CVX. Yes, I'm in LNG. Great. I'm just there. There we go. So what the rally in an uptrend. Let me just tidy this up. There we go. So just so you can see visually what we've just done. Price is in a rally. It's above all three moving averages. You can see the algo's fired off its entry here. It marks it off on the chart for me. So this is my profitable trading opportunity. It is rallying away from the moving averages. Am I in this trade? Yes, great. I'm doing everything I'm supposed to be doing. Now, here's the catch. If I'm not, I get to ask why. Why aren't I in this trade? There might be a legitimate reason. Maybe you've taken a few days off. Maybe you've just started with this strategy. So maybe today's day one for this strategy for you. And that might mean that, you know what, I've only just started the strategy today. So you've got to wait for the next dip in the uptrend so that you can participate. Anyway, if you've been following this for any length of time, you should be looking at this. We've got a rally in an uptrend. Are you in this trade? Yes, great. CVX. Same process. It's a rally in an uptrend. It's like you can see my trades here. I was a little bit early with my trades, sit through a trade, and it's again fired off a new algo trade. Don't need to worry about that. I'm already in, but rallying in an uptrend. Great. Am I in this trade? Yes. I was early to the trade. I don't need to worry about a new trade. I'm just waiting to manage the trade profitably to a natural conclusion. LNG, bull, 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 blue, blue, blue. Brand new trade. This fired off just a few days ago. Am I in this trade? Yes. Great. Nothing for me to do here. I'm in all my bullish potential. If the market swings up, I will or should make some money. So that makes it, is everyone happy with the logic on this? Everyone happy with the logic? I get to quality control as well as find new trades. So a new trade, SQM, it's a dip in an uptrend. It's dipping below all the 20, the 50. I think what I'll do is I'll get rid of some of the moving averages. Don't need those anymore. So it's going below the moving averages. We've got a dip in an uptrend. It's starting to push above all three moving averages. It's just there. So what you're watching me do is that's the point where it will be above all three moving averages, $98.58. Currently, it's below all. It's below one of the moving averages, above two of them. It needs to be above all three moving averages when it starts pushing away. So I've just drawn some crosshairs on there. When it's above all three moving averages, go long. Is it there yet? No. Come back. In this case, Monday. I'm not going to worry about it today. I'm certainly not going to sit here all day hoping that it does the thing that I expect it to do. Again, I'm swing trading. I'm not worrying about the 10, 15, 20 cents that I could miss. I'm waiting for the big dollars. Anyway, AMD. So let's do this. Bearish trades. I should be in all of these. Let's check it out. AMD. We've got a bearish trade on AMD. I've actually got a short-term trend algo rather than the daily trade on this. I'm a little bit more active with this, but the daily charts has just fired off a brand new trade. Let me just zoom in so you can see there. Sell the rally in a downtrend. And again, it's just fired off a brand. You can just see the little red arrow just by the cursor. It's just fired off a brand new swing trade again. I'm already in this, so I don't need to worry about it. I've got this rather than on the daily charts. I've actually got this on my short-term trend algo. So I'm a little bit early to my trade, as you can see here. I've got it marked off. But nonetheless, that is where I'm at for the moment. Amazon falling out the apple tree. If you'll pardon the mixed metaphors. Am I in this trade? Yes, the algo fired off just a few days ago. Also in my short-term version of this. Again, a little bit early to the party, but nonetheless, prices gapping into a profit post-earnings. So again, I've already got a little bit of exposure on this. Daily charts is presenting a trade opportunity, or it presented a trade opportunity just a few days ago. Again, so there's lots of opportunities to get in there. BBWI, am I in a trade? Yes, I am. Again, rally in a downtrend. The algo's already fired off. I'm just sitting through a little bit of sideways. I'm waiting for it to get going. Baidu is, again, red, red, red. Get to quality control. Got a lovely trending move. This actually hit target for me. And I've actually taken a brand new trade on this on the lower time frames. You can see my crosshairs. Again, the trade fired off yesterday for me. Again, algo is just a little bit late for some reason, but nonetheless, I took my trade yesterday just in the interest of disclosure. I think I actually emailed this out. I think I actually emailed this out yesterday. I know I made an announcement on my social medias, but nonetheless, new bearish trade again. So the daily chart is, again, pushing nicely. Am I in this? I have been. I've had multiple trades on this, been in and out this on the 60-minute charts, if I'm going to be honest. Marvell. So here's a trade. It's just fired off. I was just going to say, I don't think I'm actually in Marvell. So we've got sell the rally in a downtrend. It's a little bit slow and sluggish on its going. I was going to say, I'm not actually in this. I actually missed the previous one, which was a little bit frustrating. Sometimes it just happens. Price moves quite fast. Away from the chart again. I'm certainly not sat here all day. So I've got to ask myself again, quality control question. Why aren't I in this? I'm not in this. Why haven't I been in it? Just a series of unfortunate events. I like to go hiking once or twice a week. It's just been one of those occasions where prices moved quite sharply, favorably, before I've been able to participate in a move. On the bright side, though, it has fired off a new trade, and I will participate in this later. I've just missed some of the previous pushes on this particular one. NXPI, I think it's in a giant consolidation, as I recall looking at the chart, or it has been in a giant consolidation. Again, I've got trades on this pushing away. There's a brand new trade pending below $45 or so. And again, but multiple trades on this particular one. Is everyone happy with this logic? So when you've got a clear-cut rule-based strategy, visually I can see, okay, I should be in these trades. One of them I'm not. I've got legitimate reason for missing it. I wasn't physically at the desk to place the trade. I make it a habit to not trade via mobile. or on my mobile, more importantly, but nonetheless, that is providing a legitimate reason for not being in this. The other trades are rallies in a downtrend. Again, we've got several candidates there. Again, we've spoken about those in the past. We've spoken about those in the past, so I'll forego looking for entries and just think about the quality control side of things when we look at the strategy. So 3 bullish trades I'm already in. We've got 1, 2, 3, 4, 5, 6, 7 bearish trades. And one of those legitimately not participating in just because I wasn't physically at the desk. So great. Am I in all my potential? Let's go back to my little slides. There we go. So what stocks are we looking at? Again, I've got top 25 stocks. What stocks have I managed? Again, we don't really need to worry about that. Did I do everything I said I was going to do? This is relative to the strategy. If you're not following the strategy process, you've got to ask yourself why. It could be that you found the trade and you didn't place the trade. And that's what that is questions in relation to. Again, I should be selling the rally on Marvell, for example. So am I in all my potential? No, I'm not. Did I do everything I said I was going to do? Well, I physically wasn't at the desk to trade Marvell, so I can give myself a free pass on that one. I'm going to look for the next opportunity to participate in that particular stock. In regards to research, again, don't really need to worry about those. What lessons have I learnt? Again, don't really need to worry about those right now. So just focusing on these questions. Did you do everything you said you were going to do? Are you in all your potential? And again, when you have a very strict rule-based strategy, then you get to quality control, which was the whole purpose of this session today. So let's throw the question over to you. Are you in all your potential for your trading? Are you in all your potential for trading? Question. I just saw the question marks. I forgot what I'd written on the slide. No, here. All right, that is, for a change, I'm actually super early with my talking points. Quality control. Are you doing everything you're supposed to be doing? That's very open of you. Ron's just saying, no, missed a couple. So what we get to do is just follow the Socratic method. I am a fan of the Socratic approach, which is just a fancy way of saying, let's ask questions. There you go. Socrates or the Socratic method is again, or one of the elements of it is to ask questions, pose questions, and have a curious, childlike mindset. So if you have missed a few trades, Ron, we get to ask ourselves why. Like, why did you miss it? Like for me personally, like the Marvell trade's a good example. Like I physically wasn't at the desk to place the trade, so I can't be pissed off for missing the trade. And yet so many people will be pissed off because they missed the trade. Like it set up perfectly and it went to the moon, the Mars, or it sold off. And like the reality is if you're not there to place the trade, I can't be pissed off about that. Like, I mean, you should take satisfaction in the system working. Just on this occasion, you weren't able to participate. So that's the best way of thinking about it. And that's how I like to kind of justify it in my own mindset, because otherwise you're just going to have negative self-talk all the time. I didn't do this and I didn't do that. Well, the strategy worked, but you get to investigate, okay, well, if the strategy worked, why wasn't I involved in it? Well, if you're not at the desk, that's an okay reason. But then if you're at the desk, and you watched it and you traded and you followed your process and you found the trade, and you're looking at it and it went through your entry criteria and you're still watching the trade, then you've got to ask yourself why. Why didn't you take it? Is it because you're fearful over it working or not working? Most of the time when you have some sort of emotional response to or negative response to a trading situation or trading setup or just some sort of experience, your position size is probably too big. If you reduce your position size down to a sensible point, it will allow you to not hesitate. Because, and again, a good way of thinking about position size is, sorry, in the context, sorry, I had a little mental brain freeze. Most newer traders are focused on how much they can make if they're right. Most traders are focused on how much money they can make if they're right. If this works, I will make a multiple of the risk, and I will make a metric shit ton of cash if I'm right. Therefore, I will trade with as big a position size as I can on this one isolated trade idea on the hopes that that was the one. And then inevitably get stopped out and wonder why it's not working. Now, a better way of thinking about risk is to think about how little you can lose. Because we've already established, I don't know which trade's going to work. You don't know which trade's going to work. Hoping that it will work, well, we all know that how that works out. Hoping that a trade's going to work the way that you expect it to work, and then putting all your chips in the table. I'm mixing so many metaphors today. Hoping that it works is a fool's errand. You might as well just go to Vegas and gamble, because that's the mindset. What we want to be thinking about is how little I can lose. Risk mitigation. And this is how professional traders operate. How little can I lose if I'm wrong? The profits legitimately take care of themselves. They always take care of themselves. Again, if you compare it to the real world of business, most businesses who have been around for any length of time, they do this. Yeah, they do this automatically. Like, they're not buying $1 million worth of stock and hoping that they can sell it over the weekend. And sure, there's times where there's been a hot trend like fidget spinners, or there's a time of year like a Black Friday sale, and you just happen to catch the wave of trade, but it's not normal business practice. So what would be a better opportunity is you get some samples, you buy a small amount of acceptable stock, and then you market it to the customers. And if you happen to sell it and it's well received, then you can buy some more. That's how businesses work. Or you pre-sell, you take orders. I appreciate we can't do that in trading, but you see what I'm saying is you don't think about one big win in the real world of business because you think that's fucking stupid. But for some reason in the realm of trading, reality gets thrown out the window by a lot of people. All I'm trying to do is bring reality back to trading. How little can I lose? The profits will take care of themselves. And what that allows me to do, it frees me up to have lots of little trades, have lots of little, on the top 25 stocks, lots of little trades. I can have a couple of trades on the bullish side. I can have a couple of trades on the bearish side. Several of them are going to be on the sidelines waiting because there's a rally and a downtrend, but it frees me up to be ready on the sidelines. Again, I don't know which one of any of these are going to work. What if, worst case scenario, all of these trades just flat, don't go right? There's going to be a time where there will be a cycle of trades that just don't work. And that's got to be okay. So what we're trying to do is have the ability to be in business tomorrow if it goes wrong. So if you're always, focusing on mitigating the risk or minimizing the potential downside, the upside takes care of itself. It always does. But if it's wrong, I want to be in business tomorrow. I've been in a situation 3 times over the last 28 years where that minimizing the losses, minimizing the downside has worked to my advantage because it's happened 3 times. And I've only not wiped myself out 3 times because I've been protecting the risk. I have blown my 50% of my account up 3 times. Again, human error, stupidity. I've spoken about this at length in the past, but one of the reasons why it's not been complete wipeout and I've gone to stack shelves in Walmart is because of this risk mitigation approach. Every trader who's had any experiences has had some experience at cocking up. Again, I'm not shy about talking about my, they're not necessarily failures, but let's call it expensive market lessons. I've had plenty of them. And no doubt I'll have another one in the future. But the distance, the time between the big lessons gets further and further. Exactly, learning opportunities, we've all had them. The time between these lessons, complete cock-ups, gets further and further apart. At the moment, the 3 big ones, they've all been separated by about 8 to 10 years. I've had some huge market lessons. I've had a few little ones as well along the way. But it's learning from them is what we want to be thinking about. So learning from them is what we want to be thinking about. So that is certainly clouded the way that I've evolved as a trader. And they're just thinking about the quality control side of things today. Am I in all my potential? Yes. If the answer is no, then we get to ask that question of why. Why isn't it? Usually the answer is you're scared. There's some sort of emotional reaction. And often the root cause of that is position size is too big. Position size is often too big for most people. Right, folks, I think we're going to wrap it up a little bit early for a change. Lo and behold, I've actually run out of things to say when it comes to quality control. If you've got let's go through. There's one or two people asking about some stocks. If you want me to do a little round robin, let's take a look at some of the stocks. So we've got TTM, Tata Motors was just being asked about. Let's take a little look at this. So right now we are in a bearish stance. One of the things that I like to do, let's just clear that off. So from a mechanical rule-based approach, there's the 200, there's the 50. So you've got to be bearish. Now, one of the things that jumps out at me is we've got 1, 2, 3, 4 crosses in the moving average, and that's the 20 and the 50 is flipping and a flopping. 1, 2, 3, 4 in a very short space of time. And you can see that there's almost no vertical separation between those. So that's the thing that jumps out. So we do have a bearish mechanical situation. So I'm biased to the bearish side. However, is price trending? Is price trending? Let's throw that open. The only way for the 20 and the 50 period moving average to be flipping and a flopping is if price is oscillating. When I've got at least 3 crosses in the average price, the 20 and the 50, I'm going to say that this is a mechanical consolidation. I don't care what it's called. I'm not going to draw trend lines. I don't care whether it's some sort of triangle or wedge or fractal pattern. Let's press the easy button. Let's draw a big box around the whole thing and call it a consolidation. Let's do it. Let's draw a big box around the whole thing. And let's say that is, because when we have a definition that we can all agree on, price is in a consolidation. We have multiple crosses in the average price. We're making statements. You can agree with that statement. I can agree with that statement. Fabulous. Let's not worry about the exact lows and the exact highs. Let's just make sure that price is contained between the upper and lower boundary. Great. Okay, that is a consolidation. We're all in agreement. Draw a big box around it. Wait for the breakouts. Cool, cool, cool. I'll do that in just a second, Martin. Martin's asking about Jefferies Financial. Is everyone happy with that? When you have at least 3 crosses in the average price, we're anticipating a consolidation. It does require visual inspection, but mechanically there is, again, just counting backwards, 1, 2, almost 3, definitely 3 there. There's number 4. There's little time and virtually no vertical separation between at least 3 of those. We've got more than 3. So let's draw a box around it, call it a consolidation, and I can revert from selling the rise, buying the dips to saying, okay, well, price is in a consolidation. Well, what are my choices? I can buy range lows, sell range highs, buy the sell the break of range lows, and buy the break of range highs. They're the other 4 money-making patterns. And at no point have I said what this pattern is. There's no trend lines involved. There's no, did I get the angle right? Should the trend line be? We're taking away the subjectivity. We're all in agreement. That is where price is contained. The highest high and the lowest low of the consolidation. I'm not going to worry about the pennies. Don't worry about the exact highs. Don't worry about the exact lows. Just acknowledge that price is in a consolidation. Fabulous. That's all we're interested in. Recognize the phase, and then we can adopt the appropriate strategy. And maybe the strategy is, well, wait for the breakout, and then you can reapply the trend trading strategy. If you're happy trading consolidations, you can apply a consolidation strategy. Jeff Burries Financial, JEF for Martin. Let's do it. Any other stocks while I'm just waiting for this to get set up? Let's do it. Right, same process. What catches my eye again? Firstly, the mechanical rules. We've got the 200 there, we've got the 50 there. So the mechanical direction is bearish. However, looking at the 50 period and the 20 period moving average relationship, it's just about to cross over there. Not quite. It's close enough. By Monday, it will have. Let's call that a crossover. 1, 2, 3. Again, looking back, 4 and 5. Oh, again, just pinched very closely there. So it's very, looking at the times they're priced, it's almost exactly the same level there. So we've got 1, 2, 3, we've got 4 crosses in the average price in a relatively short space of time, and there's no vertical separation on most of them. So why don't we, instead of saying or trying to force a trend, there is no trend. The only way for the average prices to cross over multiple times is if price is consolidation. Right, well, let's call it a consolidation. Take up my own advice. Let's draw a big box around it. Let's take the lowest low and the highest high of the area. What do you reckon? About there, Martin? There we go. So where is price? It's inside the consolidation. What are my choices? Well, to resume trend trading, I want to see a breakout and a pullback. On the bearish side, breakout and a pullback. I could trade a bearish range reversal. I could trade a bullish range reversal at the range lows and highs. They're the other 4 money-making patterns. Oh, AMAT, you're talking my love. That's actually on my watch list, David. So one more from David. That's on my watch list. AMAT, sell the rally in a downtrend. Before I've even looked at it, I was looking at this yesterday. Sell the rally in the downtrend. Now, this is where we've got, this is one where we've got the 200, we've got the 50. Again, visually, we can see it's pointing down. Again, we've got 2 crosses there. Again, but that's it. So 2's not it. We need 3 crosses, was what I was going to say there. So there are 2 crosses, but not 3. But price is definitely sell the rally in a downtrend. We're back up to the 50. I've already got my entry condition marked off. Me personally, I'm just waiting for price to push below around about $86, a little bit below it. So below $86, I'll be selling the rally in a downtrend. It's not there today, so it's not there. Come back on Monday, and that's what I'll be looking to do, looking to sell the rally in a downtrend. There we go. AMAT, nice and simple. Sell that rally. Sell that rally. Sometimes I'm asked. So on the bullish side, we have a breakout here, Lockheed Martin. So sometimes we have a little bit of conflict. I'm occasionally asked, at what point do I consider chasing the trade? Again, so we've got sloped. I don't often draw slope and trend lines, but when I do, it's usually going to be a parallel channel. We've got multiple crosses in the average price. So I'm not disputing the fact that we have a consolidation. I happen to recognize that it was sloping. And we have a breakout at that point. Now, what I typically like to do is buy the pullback after the breakout. So we've got a tiny pullback there, just paused for a day and then it carried on. I have a hard time buying that because we have a huge move. It started at 400 and ended at 460. I'm not going to be buying. I don't really want to chase that. So this is more managing the psychology of a trader. For the moment, it's working out. And with the benefit of a few days of hindsight, of course, I should have bought the breakouts. But the reality is, emotionally, as a trader, I have difficulty buying that breakout. So what I want to see is I want to see it come back to around about 450 and put in a deeper retracements first. So I'm happy to let that initial move go. And I'm okay with that. So again, just in the interest of disclosure, again, we've gone from consolidation to raging breakout trend. Benefits of hindsight for the moment, of course, that would have been a great trade. But again, psychologically, that doesn't sit well with me. So again, I don't always take the, I'm not going to buy rallies is what I'm trying to get to. That's really what it comes down to. I don't like doing it. I don't like chasing it. So if you ever feel like you're chasing, let it go. B-A-B-A. So Alibaba. One more from David, and then we'll wrap up the session. To be fair, let's throw it open. What do you think? Is it buy the dip or sell the rally? Is it buy the dip or sell the rally? Let's throw the question open. Is Alibaba buy the dip or sell the rally? With everything that you know from today's session and past sessions, is it buy the dip or sell the rally? Bam. Sell that rally. So what I need to see, so right now it's in sell-off mode. There's no rally to sell. So we've got a very clear trend, first and foremost. Let's zoom in so we can see the detail on the recording. So price right now is below all three moving averages. The algo fired off about $80. Again, so price is in the profit part of the phase. What I refer to as a phase 3 trend. So it's in the profitable part of the trend. So what we want to see is for a brand new trade, for it to come back to the 20 or the 50, one or the other's fine. But at that point, I can start to say, there is my rally in a downtrend. And when or if it pushes back below all three moving averages, then that's the bit that I want to profit from again, that would allow me to participate in the rally in a downtrend. So right now it's selling off in a downtrend, and I'm looking for the rally part. So that's what I'd need to do. So it's not no, it's just not today for Alibaba. Absolutely. I mean, yeah, I mean, this is, if we were thinking about trends, we want to buy at a discount. So all we're doing is the opposite of buying at a, I mean, again, to quote Warren Buffett, we want to buy stocks when they're out of discounts. And conversely, we want to do the opposite. We want to sell the rally. You know, it's just a different way of saying buy the dip and sell the rally. So yeah, wait for the pullback. And all we've done at the start of the session was define what the trend is and what we're going to define as a sellable rally. Again, a pullback in this case, or a buyable dip for that matter. And we're going to ignore every up and down day, because if we're not in the zone for us to trade, then it's just noise. Let it go. Wait for the better opportunities to participate in market movements. And you may miss some of the movements. Again, Lockheed, I'm missing Lockheed, or am I missing Lockheed? Maybe I get the entry that I want. We'll tune in next month for the next exciting adventure of, was there a dip on Lockheed Martin? We've got to be okay with letting the occasional trade go. We're going to miss a few trades. Again, Marvell, Lockheed for the moment. But one of the things I have noticed is, with the benefit of hindsight, a day, a week, a month, often you're not missing a great deal. You're often not missing a great deal. So this is another benefit of portfolio trading. Again, there's at least 25 stocks in everyone's portfolio. Again, this is my top 25. So one of the, and this is really a good point to finish on. So one of the benefits of portfolio trading is there are 4 in a bullish phase. There is 1 in a dip. 1, 2, 3, 4, 5, 6, 7. There's 8 in a rally. And there's 1, 2, 3, 4, 5, 6, 7. There's 8 in the sell-off made. So 8. So there's 4 in the rally, 1 in the dip, 8 in the sell-off mode, and 8 in the rally. So if you, let's put this in the context. And again, there's a couple there's 3 that I've just taken off. So there's actually there's 22 stocks here, or there should be 20. There's actually 21 because I've just removed a few off the bottom for no particular reason that we need to explain right this second. But there's some bullish trades, there's some bearish trades, and it's these 9 that are the opportunities. So there's 4 that are profiting on the bull side, 8 that are profiting on the bear side. There's 9 that are dipping or rallying in the context of a trend. And if one of those just goes without you, well, that's okay. There's 8 more on your dance card. Does that make sense? So another benefit to having a portfolio of opportunities, maybe you do miss one legitimately, you know, you just physically not at the desk when it goes without you. You know, hiking, you're going out. It's like, I'm going to turn off. Got a few things that I want to do, enjoying, some party time. So maybe there's going to be a couple of things that I missed today because I'm not going to be at the desk for the rest of the day. And that's okay. Lockheed, Lockheed I may miss. That's fine. I've got to be okay with that. Marvell, I've missed. So there's 2 on my dance card out this top 25 that I should be in, but I missed. And there's legitimate reason for me not being them. So I can't be pissed off, because guess what? There's 9, 8, there's actually 7 other stocks that are on the sidelines, waiting, ready, poised to spring into action. So there's no big deal. And I'm not missing on the move. I've got 4 bullish trades and 8 bearish trades. And the rest, you see where we're going with this? You're not dependent on one opportunity. You've got a portfolio of opportunities. So again, don't stress over missing one. or just not being at the desk to miss one. And if you legitimately just do the rabbit headlight things and watch it and wave it goodbye without you, that's okay as well. Just don't miss the other 9 is all we're getting to. We can all, miss the occasional one for whatever the reason is, whether legitimately or you talk yourself into or out of it. But if you're following a rule-based process, you get to kind of quality control, you get to check these things. But more importantly, you're never going to miss the market movements because something's participating somewhere. It's just my individual trade that's, maybe you just let go without you for whatever the reason is. Either you talk yourself out of it or legitimately you couldn't place the trade. It's no big deal in the big context of things. David, last question from David. I trade multiples. So my preferred core strategy is with daily charts. Most of my decisions are made on the daily charts, and I'll trade the daily swings in the markets. So the idea behind this is to get paid at the end of the month or the end of the quarter. I also have a short-term strategy and apply the same strategy on a select few 60-minute charts. So I'll have 8 or 9 positions on with the 60-minute chart version. It's a little bit faster. So the idea behind this is to get paid at the end of around about 7 to 10 days on average. I've also got a short-term strategy for S&P futures. And again, the idea behind this is to benefit from the main move of the day on S&P futures. So that's what I plan on, or how I plan on trading with these 3 time frames. Again, which one's right for you is going to depend on the time that you have available. If you've got no time to be more active, then it makes no sense to look at the daily charts. It makes no sense to look at the shorter term time frames. It certainly makes no sense to look at the 2-minute charts, because you could also trade the main move of the morning if you want to be more active on the day trade side of things. Again, there's no single right answer for any of these things. A lot of the time, it's what time do you have available? If you've got more time to commit to this, if you can spend 30, 60, 90 minutes around about the opening bell, then maybe you've got the means and the ability to be more actively engaged in the markets. If you've got less time, if you can only check things at the end of the day or every other day, then you're going to restrict yourselves to using daily charts. And again, they all work. It's relative to your situation, depending on how much time that you have available. Does that make sense, Martin? So it's not a case, it doesn't really matter what my preference is. It's like, well, what time do you have available? Other factors that I want to consider is like time freedom. Like, I want to be able to do everything that I could do without being glued to the charts. I don't like, while I can day trade, I can spend 2 or 3 hours day trading on a regular basis. I don't want to be sat here all day, every day. I want to check in, check for my trades, and check out, which is what I plan on doing after I finish talking on this call. I'm going to just double check everything, make sure nothing needs doing. And then guess what I'm going to do? I'm going to log off. I'm going to go out and party with the family. That's what I plan on doing. So I don't have to be sat here at the computer on for multiple hours at a time. Everything that I could do or needs to be done can be, even if I'm doing the short-term trading, it could all be done in 20 to 30 minutes. That's how I want to trade. As a byproduct of that, it means that you get to benefits, because maybe you've got other things that you want to do. You've got the day job, you've got family commitments, you've got other things that you're doing in your life. I don't know what your lifestyle's like, but I want a lot of free time to be able to do things that interest me. I'm very fortunate to have managed to figure that out. It wasn't always like that, but it all started because I've got Crohn's disease, like way back in the early noughties. I physically couldn't trade. Even if I wanted to be sat here for hours at a time looking at the charts, I physically couldn't do it. I was ill. I would have an hour, maybe 90 minutes in the day where I was, conscious essentially. Because Crohn's disease, there's a fatigue illness, lots of other nasty stuff that comes along with it. But I was ill for a long period of time. Yeah, no, but you get what I'm saying, David. It's like, for a long period of time, like I even if I wanted to spend 6 hours doing this, I couldn't physically do it. So I had to compress everything that I could do, should do, or would do into a very short space of time. And as an added bonus, as you might know, David's commenting on, his wife's has a similar condition. Like, as an added bonus, you don't know which hour is going to be the good hour, do you? You just know that you're going to have a window of consciousness at some point. Again, thankfully, these days it's fine. In my case, I have permanent mild symptoms, so I get tired on a regular basis. And again, that's just the way it goes. Yeah, that's just the way it goes. Again, I only mention it just to illustrate that's influenced the way that I do things these days. But yeah, that now it gives me time freedom. Other side benefits of doing things the way that we do it is we get a lot of time freedom, and that obviously is what I want from my life. Yesterday I went Tuesday I went hiking. Thursday I took off, but yeah, I like to go hiking once, twice a week now. I'm going to enjoy things again today. I'm going to spend some time with friends and family, but again, it's just that. Do you really want to be sat here aimlessly looking at chart after chart, or do you want to be plug into a system, go, there's the trade, or not, as the case may be, and go and do something else for the rest of the time with the rest of your life? That's how I want to do things. Anyway, I think we've all kind of got the point of that. Right, so we've had a great session today. Everyone's super involved, super active, so that's absolutely awesome. I think we've got most of the questions, most of the requests for individual stock picks. As I said earlier, if you would like to work more closely with me, you can do it. It's by application. I don't work with everyone. I don't need to. I am a trader first, as I mentioned. But if you would like to work more closely, just understand if you don't change anything, nothing will change. If you're not getting the results that you want, then you've got to ask yourself, what do you need to do differently? So right now you've got two choices. You can keep flapping around as you are and try and Frankenstein a profitable system together before it's too late to make a real difference. Or you can plug into what I'm doing. Press the easy button and plug into a tried and tested trading system. I've been developing this for the last 28 years, almost 29 years now. As you saw, I've got a lot of software, and most of it's algorithmically coded, which is the fancy way of saying the computer does some of the heavy lifting for me. And again, we manage quite a lot of money around the world in various funds, and several funds actually use this algorithm. The bottom line is I want to get you results. Again, I've got my results. I had no one to ask when I first started out. But again, just some of the results that I've had recently. Again, I'm pretty open. I don't run a newsletter anymore, but I generally post what I'm doing almost in real time. And again, here in these open sessions, you get to see the benefits of those. So if you would like to explore and see if it's right for you, just go to my main website, AntiVestor.com, and follow the process, follow the links. You'll be asked a few short questions about your trading experience and where you're at. It doesn't matter whether you're brand new to trading or more experienced. I just want to know if you're coachable is really what it comes down to. If you're not coachable, then we definitely can't work together. Unfortunately, that's just a fact of the way it is. But nonetheless, if you would like to, there is an invitation to work. If you don't, if you've got everything that you need from today's session, that's great. Just share today's session with someone who needs to hear what we've spoken about, and just pass it along and help the next trader along their journey. Right, with that said, as always, just put it into action. Just do it. You've got my trend and entry mechanism. Go and do it. Go and find some trades. You've got my top 25. If you want some help with it, if you've got any follow-up questions, shoot me a message. Make sure that you're in the Slack community. I am most responsive there. Again, feel free to just shoot me a message. Again, just click on my name. Again, the links to the Slack community are in any of the links that you, or any of the emails that you receive from me. Just shoot them over and I'll answer them when I see them. Until then, though, until next time, let's do it. Game over. Have a wonderful weekend. I intend to start mine right now. But yes, enjoy yourselves. If you've got any follow-on questions, shoot them in the Slack or hit reply on any of the emails. And as promised, I will answer them as soon as I have some bandwidth to give you a serious answer, or maybe even a whimsical one. Nonetheless, have a great weekend and enjoy yourselves.